Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang Patel. So I interview physician turned financial author and investment advisor, Dr. William Bernstein. Dr. Bernstein's written many books about his investment philosophy and the history of investing. He's a neurologist who's turned into a financial author and investment advisor, and many of his books are regarded as classics in the financial investing literature. Most of us won't be able to reach the asset threshold needed for him to directly manage our money, but the good news is we don't have to. With his appearances on different podcasts and lectures, as well as the books that he's written, he's provided most of the framework that the rest of us would need for strong investment portfolio for the rest of our lives. I've admired Dr. Bernstein's approach to investing for many years and want to acknowledge him as one of the pioneers of index investing. His books are a must-read for those who want to learn about financial history. Despite his tremendous expertise, he's very accessible and approachable, and above all, a teacher. In this episode, we discuss his basic advice to young physicians, what he recommends you do before starting to invest, how you can construct a very simple yet effective portfolio. He also goes into his thoughts on cryptocurrency and where we are in this potential bubble. He talks about the FIRE movement and how that may affect your asset allocation and savings rate. And finally, he talks about whether most physicians would benefit from a financial advisor. Without further ado, Dr. William Bernstein. So, welcome to another episode of the Dr. Money Matters podcast. My guest today is Dr. William Bernstein of Efficient Frontier Advisors. Dr. Bernstein is a prolific author in the financial world and has written many books about investing and finance. His books range from the straightforward guide, if you can, for beginning investors to the more in-depth and classic books such as The Four Pillars of Investing. There are many other books that he's written as well, and I encourage you to read them and go to his website for a full list of his books if you're interested in broadening your financial and investing knowledge. Dr. Bernstein, welcome to the show.
Glad to be here.
So I wanted to talk to you about finances and specifically the issues that many physicians face with investing. But before we get into that, you being a physician and neurologist, also a PhD in chemistry, let's talk a little bit about your background in medicine.
Well, it's pretty straightforward. I'm one of these people who's typical of my generation. I knew from the time I was about 11 I was going to be a doctor, and ran straight through. Did a degree in chemistry first because I got sidetracked by that, but then I decided I wanted to eat, and so I trained as a physician. And if you want to know how I segued into finance, I practiced for 25 years on the coast of Oregon, basically doing rural healthcare. And somewhere around the early 1990s, I realized that I lived in a country that didn't have a functioning social welfare system, and I was going to have to provide for my own retirement. So I did what I thought anybody with scientific training would do, which was that I reviewed the peer-reviewed literature, and then I collected data, built models, and by the time I was done, a few years later, I realized that I had accumulated something and built something that was actually of use to small investors. It had always been available to professional advisors and professional investors, but it really wasn't available to the small investors. So I wrote it up, started a website back in the day, 20 years ago, when when small communities were first starting to get hooked up, and I started writing from my website. What 10 years later would get called blogging. And, books get published, and I started getting quoted in the media. And when that happens, people start asking you to manage money. And so that's pretty much how I got to where I am.
Okay. So you said you were practicing neurology, right, for a number of years, and then you transitioned into this. How long have you been now exclusively in the financial world?
I retired from active practice in 2005. I taught for about 10 years after that on a volunteer basis up at our local medical school. But really, I made the transition, I would guess, about 13, 14 years ago.
Okay. And so did you have, other than applying scientific analysis and a process to learning about finance, did you have any formal training beyond? None
whatsoever. And that's actually not at all unusual. There have been some fairly famous people in finance, most notably Fisher Black, who had no formal training in finance.
Okay. And I think it's a good point, because a lot of physicians are very, very hesitant. There's a subset of physicians who are very interested in it. And then I would say a greater percentage are really not interested, but even more so, I think they're a little bit scared of the finance and some of the the analytics and skill sets involved. And I'm not advocating anyone talk about high detailed personal financial analysis, but I think that it is something that can be learned, and a lot of physicians have the academic ability to do it. Now, whether they choose to do it is a different story or not. But so I think that it's great that you mentioned that a lot of it's not unusual in the financial world that people have learned this just by applying the scientific analysis. So let's talk a little bit about your investment philosophy. You just came back from a talk at the White Coat Investor Conference, and that audience is pretty friendly to your type of investment philosophy, which is pretty straightforward, passive index investment. Talk a little bit about how you came about that process or that philosophy.
Well, it has both a very firm theoretical and an empirical basis. I'll start with the empirical basis first, because once you understand the data, then you have to understand why the data looks like it does, or they do. And the data are as follows, which is that when you look at professional money managers, there's actually no evidence of skill. If you take a typical activity for which there is skill, say major league batting, you find that above average batters in one year tend to be above average the next year. And what's really interesting in finance is that only at very short time horizons is that true. Over a period of 6 months or a year, the manager who did a little better than average will do very slightly better than average the next year, but will still not meet the benchmark. In other words, they'll still underperform the index. But what's really interesting is when you look at it 5 years, which is, the long term is really all that matters, 5 or 10 years. If you look at the people who've got good 5 or 10 year batting averages, they actually have, on average, slightly worse than average performance in the following 5 or 10 years. So the performance really doesn't persist over the time horizons that really and truly matter. And it's kind of like, if the major league mean batting average is 255, which I think is what it was in 2016, it means, it would be kind of as if the guy who batted 300 one year on average batted 250 or 245 the next year. So there's almost no evidence of persistence. Now, everybody says, well, what about Warren Buffett? What about Peter Lynch? And there's two things about that. Number one is they were clearly skilled, but the problem is it's the needle in the haystack problem. Is for every one of them, there are 100 people who plant their faces after having had good track records. And then the trouble also is that no matter how good you are, and Warren Buffett is good, after a while you acquire so much assets that you have market impact, and that works against you. And so you don't beat the market. Warren Buffett actually has underperformed the S&P 500 very slightly over the past 15 years. And he's underperformed it by about 1% a year over the past 10 years. Wow. So, if Warren Buffett can't do it, what are the odds that you're going to be able to do it? Now, that's the empirical data. The theory behind it is really very simple, which is that professional money managers essentially are the market. So in the aggregate, they have to get the market return minus their expenses, which are considerable. It's not just the fees they charge, it's also their impact costs, because they're managing so much money. And whenever they decide to buy or sell a stock, they move the price adversely. And that works against them. And the analogy that I use is that when you, as a small investor, buy or sell a stock, there is always somebody on the other side of that trade. And, whenever you sell, there's someone who's buying the stock from you and vice versa. And that person most likely has an IQ of 160, is working 70 hours a week, and has access to data and IT that you could only dream of. And probably has a name like Warren Buffett or Goldman Sachs. But even that's not the worst case scenario. The worst case scenario is not trading against Warren Buffett or Goldman Sachs. It's trading against the CFO of the corporation whose stock you're dealing with, who probably knows more about the company than anybody else on earth. And it's kind of like you're playing tennis with an invisible partner, okay? And what you don't realize is that the person on the other side of the net is Venus Williams, all right? And so the odds of your winning that game are small. Now, we've all heard about overconfidence, and the specific kind of overconfidence that physicians have, aside from this general overconfidence, that they can handle anything that comes out of the elevator, is that they have some special expertise when it comes to pharmaceuticals. They'll hear about a drug, or they'll see a drug in clinical practice and it seems to work really well, or they'll have a prosthesis that they deal with in the OR and that it seems to be particularly effective in follow-up. And they think that imparts some special knowledge to them. Rest assured, it doesn't, okay? The person they're trading against probably also has an MD and has probably talked to hundreds of doctors like you. And not only that, but that doctor who's analyzing that stock knows how to read a balance sheet, and you probably don't.
Right. So that's a very good point, is that, we do, on the whole, a lot of physicians do tend to have a little bit of overconfidence in their skill sets in other fields beyond medicine. And that is a common error that they would make in investing in general. What do you think some of the other mistakes that younger physicians could avoid that maybe previous generations of physicians have made in investing? Obviously, you just described something like trading individual stocks. What are some of the other things that the next generation could hope to avoid?
Well, there's two big mistakes that physicians, and I think most people make in investing, but particularly physicians. In the first place, they don't save enough, okay? A BMW is not a motor vehicle. It is an IQ test, all right? A McMansion is not a place to live. It is a measure of your self-discipline. And so if you cannot save, all right, it doesn't matter if you're Warren Buffett, the early Warren Buffett, you're shafted. It doesn't matter how good an investor you are if you can't save any money up. So that's the first mistake that physicians make. And Jim Dolly, who runs the White Coat Investor, his mantra is live like a resident, live like a resident, live like a resident. Okay, right. And you will thank yourself if you do so when you're older. There's another bad thing about living the high life when you're young, when you finally get out into practice and you're making that nice salary, which is that you get on the hedonic treadmill, okay? So if you get used to the Beamer and the McMansion when you're fresh out of school, by the time you're 45 or 50, it's not going to be good enough anymore, okay? Whereas if you live like a resident for several years out of practice, you're going to hug yourself every time you stay at a nice hotel when you're older, So there's that aspect of it too. The second big mistake that physicians make is that they do not treat finance as a serious topic. Okay, you wouldn't treat so much as a sniffly nose in a patient unless you've learned anatomy and pathophysiology and physiology and pharmacology. You've taken the basic sciences, let alone the clinical sciences. And in the same way, you are out of your mind to be doing finance without understanding the basics of four basic sciences of finance, what I call the basic sciences of finance. One is financial theory, okay? The next is financial history, which is extremely important. Mm-hmm. The next is investment psychology. And then finally, you have to learn also about the business of investing, the people who are going to be trying to sell you stuff. And that's a knowledge base that takes several months to acquire at a minimum. So, going out and investing without without learning those subjects is kind of like climbing into the cockpit of an airliner without having any flight training. The results are going to be fairly predictable. You're going to crash and burn.
Right. Okay, so that's actually a really good point because a lot of physicians do tend to get into the market, and it seems nowadays to be a little bit more accessible than it was previously in terms of getting involved in these index funds and things like that. But then once you do that, maybe there is a tendency to then, go a little bit further, maybe start buying some stocks and things like that. And I think what you bring up is a really good point, is that learning all you can about it doesn't require you to go back to medical school and do that level of detail, but there is much more work than just simply what we hear in the doctor's lounge from our other colleagues, and taking it as a serious subject is definitely good advice. And if you do that, will probably pay you back in great sums over the course of your career. Many of our the younger colleagues are coming out now with just unbelievable amounts of education debt. $300,000-$400,000 in debt is not uncommon now. One of the questions that many of them have is, what point should I start investing, or what point should I, pay off my debt? What would your thoughts be about that?
You should make investing for retirement a fairly high priority. Now, the question is how you prioritize that versus paying off your debt. Your debt is generally going to be fairly low interest. And so what you do when you look at paying off debt, the first debt you pay off is obviously your credit card debt because it has a ludicrously high interest rate. So pay that off. The only thing that has a priority over that is making your 401k match if you're in that situation, because that's free money. All right. So number one, for God's sakes, meet the 401k match if that applies to you. Number two, pay off your high interest debt, your credit card debt in particular. And then you should probably start saving for retirement, because you can borrow, to pay for your education. You can borrow to put your kids through college. You cannot borrow to pay for retirement.
Right. So, yeah, I mean, those are, and we try to emphasize that, and Dr. Daly and many of the other physician financial bloggers and just finance people in general, definitely, we all try to advocate retirement savings first, because that's a great point, is you can't borrow for retirement. So let's get it a little bit into the your simple, portfolio that you've advocated. And I think you were one of the earliest people that I've seen talking about the, relatively like the 3-fund or 4-fund portfolio. And more recently, there are the target date funds. Talk a little bit about, what would be a relatively simple portfolio construction for the average person, our average physician. And then at what point do they start, thinking maybe I should start tinkering with it and adjusting it, or have someone else change their portfolio allocation?
Well, investing, as you pointed out, investing is really a very simple process. If you've got a good low-cost target date fund, for most people, that's really all you need, okay? And a target date fund is just a wonderful investment vehicle because you put your money into it automatically. You never look at your statements. And by the way, the less often you look at your investment results and your investment net worth, the better off you are. The far less frequently you sample it. I mean, imagine how you'd feel about your house if you got a quote on your house every day. When you saw it going up and down, it would drive up and down by $5,000 or $10,000. It would drive you out of your mind. Okay. But that's what the stock market and investing does to people. It's best just to put your money in every month and forget it. And that's where a target date fund is really wonderful, because target date funds tend not to be as volatile because it's just everything together, including bonds, which tend to modulate out market moves. The trick with target date funds is they're really dandy, and I think very highly of them. The ones that are available are just a hair too expensive, and you can cut down on that expense by basically making them synthetically and just putting together 3 or 4 index funds. For example, a target date fund, you can pretty well mimic it and actually do better than it by having a mix of, U.S. total stock market, foreign total stock market, and total bond market. And the trick is that's a little more work. It takes a little bit more discipline. For most people, I'm not sure it's worth the effort. But, what I like to say about investing is that it is simple, but it is not easy. It's just like losing weight. All right. It's simple. All you have to do is, eat less and exercise more. Simple, but not easy. And the reason why you want to acquire all of this knowledge is really not to enable you to beat the market, but it's to attack the not easy part. Okay. Because the not easy part of investing is keeping your head when the markets are tanking. And if you understand market history and market theory and market psychology, you've got a much better chance of staying the course.
Right.
All right. And that's the real reason, is so you can understand what you're doing and being comfortable with it. Because if you're not comfortable with your investment policy and you don't know the theory in back of it, then you will bail when the chips are down.
Right. Right. And again, it seems like, you've been studying this for obviously a very long time. And, even someone with as much expertise as yourself ultimately has, shown with your writings and stuff that you can't beat the market. Don't try to beat the market. Be the market. And so, I think it's one of those things that it's a little bit of knowledge tends to be a dangerous thing. And then the more you gain, the more you realize. And like you were saying, as you learn and read these books and learn, especially market history and market psychology, and learn your own psychology, I think you'll eventually demonstrate better investor behavior. So let me ask you, because index funds, are very popular now, and there's a number of index products out there, and they talk, there's the total index funds, which are the some of the original indexes like the Vanguard S&P 500, but now total stock market. But there's also little niche index funds, and some people talk about an index bubble. What are your thoughts about that? Is there such a thing as an index bubble?
Index bubble, that phrase is the dying scream of active fund managers. Okay. Every year people come up with a different knock on indexing, and every year the indexes beat the active managers because of simple arithmetic. Okay. The index, an index fund will get the market return minus about 5 or 10 basis points, 5 or 10 100%. And the active fund manager gets the market return minus 2 or 3%. All right. And so it's a foregone conclusion. A year or two ago, somebody called indexing worse than Marxism. That was one of my favorites. For example, the president of a large privately held investment company that's headquartered in Boston was quoted as saying that don't worry, we'll come back. Active management will come back and we'll do fine. And she reminds me of the cargo colists waiting for the planes to return, with the coconut earphones and the bamboo antenna, trying to guide the planes to come back to the airstrip, to bring them their canned corned beef. It's not going to happen. Right.
And more literature just proves, and I think more and more awareness of the benefits of indexing just keeps getting out there, and I think more people are doing it, but we still don't seem to have reached a critical mass yet. So I agree with you. Not that I just think that it's great, but there's still way more opportunities for people to understand about indexing and benefit from it.
Well, so, and there's let me just say one more thing. There is a theoretical argument against indexing, which is that you need active managers to keep the market prices honest, and to determine the correct market price. So theoretically, you could have so many indexers that the market prices get completely out of whack. And we're nowhere near that. Only about 25% of money in the stock market is indexed. But even more importantly, only about 5% of actual trading is indexed. So, we're never going to get to 90 or 95%. And I'm often asked, how many active managers do you need to keep the markets efficient? And my answer is 2 dentists having lunch in Lubbock.
Okay. So basically you need, as long as there are people on either side of the trade, you should be okay, is what you're saying.
Exactly. Yes. As long as there are active traders somewhere in the system, right, market prices will be efficient.
Okay. So let's just talk about your broad view of the markets in general. I mean, we've had, since the 2008, 2009 downturn, the recession, we've had a prolonged period of good market returns. And a lot of experts, and I think you yourself have also indicated that, over the next decade, we should be lower than the previous 10. Not that, we're actually predicting, but just based on returns. So what are your thoughts about the next 10 years, 20 years or so in the markets?
Well, basically, this is not rocket science. I mean, the historical returns, let's start with bonds first. The historical returns of bonds have been 5%. Okay, well, guess what? You're not going to get that because you can only get about a 2% or 2.25% coupon on a 2-year Treasury note, or maybe a 2.6 or a 2.7% return on a 5-year Treasury note. That's what your expected return is. Okay. Because that bond is, you're going to buy that bond and it's going to mature and you're going to have to reinvest a little bit along the way, but that's not going to affect your return all that much. You're going to get 2.7% or 2.25% to maturity. Now, stocks are only slightly more complicated. What you do is you start with the dividend yield of stocks, then you ask what's the dividend growth rate, because you get that also, right? Mm-hmm. So the dividend rate of U.S. stocks is right now about 1.65%, and historically, generously, the dividend growth rate is about 5%. Okay, so you can expect about 6.5%, maybe 7% from stocks, but certainly not the 10%, which was the historical rate. All right. Now there are people who argue that because of buybacks and so forth, that the dividend growth rate is going to increase. I don't see any long-term evidence of that. And there are good reasons why that's probably not true. Companies do a lousy job of reinvesting their retained earnings. They're much better off, or shareholders are better off if they distribute those earnings out, but they don't do that. They retain them and they tend to waste them on acquisitions and other things that are good for the management, but not good for the shareholders. So I think that returns going forward are going to be relatively low. It is even possible if valuations revert back to something approximating historical values, the returns will be even lower than that. And there are theoretical reasons why that's true as well. I'm not going to go into the reasons for this, but as societies grow ever richer, the rate of return on capital actually decreases. So, back in a poor era, when it was harder to invest, the returns had to be higher. But now that you can invest in an index fund, buy all the stocks in the stock market by pushing a key on a keyboard, the returns are going to be much lower.
Right. Okay. And so, but again, so if returns are going to be lower, I think, and then specifically you talked about bonds. Warren Buffett, I think in his Berkshire Hathaway letter, talked about, bonds being even riskier than stocks for the long term. His point was that we're in a low interest environment and bond yields are likely to go up over time, and underlying the bond itself, will probably decrease in value. Should the average younger physician and maybe mid-career physician, should bonds be a part of their portfolio? Because there's given the low interest rate environment that we're in.
Well, Warren Buffett is one of those extremely rare individuals whose gut actually responds to the long term. Okay, the rest of us, the other 99.999% of human beings, are prisoners of our evolutionary history. So we experience risk on a day-to-day or a minute-to-minute basis. So, we tend to focus, most normal people emotionally tend to focus on the day-to-day fluctuations of the market. And there's no question that on a day-to-day or even a year-to-year basis, that stocks are riskier than bonds, okay? I mean, you can, stocks, one day into 1987, I'll never forget it, stocks went down by 22 or 23%. That doesn't happen to bonds, all right? However, in the long term, Buffett is absolutely right, okay? Between 1940 and 1980, the total return, including reinvested interest, on long U.S. Treasuries was minus 65% or so. And for English gilts, it was even higher. And so, if we do get inflation, bonds are going to do terribly. Now, a bond, technically, is a fixed income instrument of longer than 10 years maturity. All right. But, short-term fixed income, so notes and bills, note is anything between 1 and 10 years, and a bill is anything less than 1 year, is going to not be as badly damaged by inflation. Now, back to your original question, should individual young investors buy? There is no question that the smartest thing for a young investor to do is to invest exclusively in stocks. All right. Not only that, but he or she should get down on his or her knees and pray for an awful bear market. Okay. So they can acquire stocks at cheaper and cheaper prices. All right. So for the young investor, stocks are not at all risky if they have a periodic savings plan, if they're saving periodically. On the other hand, for a geezer like me, stocks are 3 Mile Island toxic. Okay, because if I have a burn rate of 5%, if I'm spending 5% of my portfolio in retirement, and if my portfolio over 10 years decreases by 50%, which could easily happen, then I've run out of money. All right, or come close to running out of money. And even if there's a strong bull market following that, I'm still screwed. All right, because I don't have enough assets left to experience the bull market. Now, having said that, I've just given you a good theoretical construct. Theoretically, young investors should invest exclusively in stocks and maybe have a small emergency fund on the side. As a practical matter, there aren't very many sentient beings in this quadrant of the galaxy that can tolerate 100% stocks. Okay, so in order to win the psychological game, you have to own bonds. And what I like to say is that an optimal strategy that you can't execute is much worse than a suboptimal strategy that you can execute. In other words, owning all stocks is optimal, but you're not going to be, the odds are that if you're a flesh and blood human being, you're not going to be able to execute that when the chips are really down. Very few people can do that. So you own bonds so you don't bail. And it's a suboptimal strategy, but it's one you can execute, which is better than an optimal strategy you can't execute.
Absolutely. I think that's great advice. And so we try to achieve the theoretical, but let's do what's actually more practical and work towards that. So I think that's really good advice. Now, one of the, we talk about stocks, going up and down potentially 50%, over your overall portfolio. Well, one of the things that we've seen actually do that in the last year is cryptocurrency. And, there's been a lot of younger physicians, particularly on social media, putting their money in. Now, I'm not sure percentage of their portfolios and things like that, and they've written this really volatile product, and I'm not really even calling it an asset because I don't particularly believe that it's an asset. I wanted to get your thoughts on it because it is something everyone's talking about.
Well, how do you recognize a bubble? There are finance theorists who say you can't do it, and that's because you can't mathematically model bubbles, okay? There's no way to identify a bubble mathematically. But it's kind of like Potter Stewart's famous definition of pornography. He can't describe it in words, okay? Or give him, he can't model it basically, but he knows it when he sees it, okay? And it's the same way with a bubble, okay? What do you see in a bubble? Well, the first thing you see is when you go to a party or you're in the doctor's lounge, and it's the first thing they talk about, okay? If you go to a party and the first thing people are talking about are tech stocks, the way they did back in the 90s, or flipping real estate, the way they were doing people were doing 10 or 12 years ago, or Bitcoin, that's one very bad sign.
Right.
The next really bad sign is when somebody quits practicing plastic surgery to day trade, all right?
That's right.
Because that's sign number 2. When people quit high-paying positions, thinking that they can make more money, by speculating. Sign number 3 is when skepticism is met with vehemence. Okay, in other words, when you express skepticism about a given investment, somebody just doesn't say, well, I disagree, you may be right, you may be wrong, but here's what I think. When they get angry at you, okay, that's the sign of a bubble. And John McAfee, the guy who's put craplets on everybody's Windows machines around the world, very famously said that if Bitcoin didn't go to some, very high value, can't remember what it was, $1 million or $100,000, he would consume an intimate part of his anatomy. Okay, well, that's pretty vehement, I think. And then the final thing is when you see extreme predictions. And we've just talked about an extreme position, Now, nothing in this world is certain, okay? And we're not going to know what Bitcoin is until the proverbial fat lady sings. But, from everything I've seen, this looks like a bubble. I could be wrong, and we're not going to know for sure until it's finally settled. But this sure looks like a bubble to me.
Right. It's it's funny because I recognize some of those exact scenarios that you were talking about. I was in medical school in the late 90s, and I had friends who were, day trading during school. And then I knew a dentist who quit his practice, to do day trading. And then during the real estate bubble, I was in Florida. My wife and I were there for a vacation, and we're at a restaurant, and we hear the waiters talk about flipping properties. And it's funny because at that point, I don't know if I just didn't have any experience or I should have recognized the bubble artifacts and that, or the scenarios. And now I am recognizing those in cryptocurrency. So it's funny that you brought up those examples because I think retrospectively I have seen those, in past cycles.
Yeah, probably the most profitable book I ever read was a book called Extraordinary Popular Delusions and the Madness of Crowds. It was published in 1842 by a Scotsman by the name of Charles Mackay. And he described the tulip mania and the South Sea bubble and the contemporaneous Mississippi Company bubble as well. I read this book, I don't know, in the late 80s, and I thought to myself, gosh, this is interesting. I wonder, I can't imagine I'm ever going to live to see anything like this. And then lo and behold, 10 years later, and that book was one of the things that told me that it was probably a bubble and to stay as far away from it as I could. And it turns out I wasn't alone, okay? Nor was I the first person who had that experience, because remember, the book was published a century and a half before that, and people in finance had been reading the book for decades and decades and decades. The book's been continuously in print ever since 1842. And Bernard Baruch wrote a preface to the 1932 edition for precisely that reason, because it saved his bacon.
Right. It's, I think it's great. It's one of those lessons, unfortunately, that I think most people, even if they had, were to read these things, they might help guard them against it. But I think most people only, unfortunately, learn by experience. So, but I hope by doing this podcast and your books and all these other resources, we can kind of help people avoid some of the major mistakes. But sometimes you only learn by, the school of hard knocks.
I'd like to believe you're wrong, but I am afraid you're right.
So there's a quote that I think is attributed to you that it's a pretty good one, but it's one that I want you to explain a little bit more. It's why continue to play the game once you've won. I'm not sure if I have the quote exactly right, but what do you mean by that?
There are a lot of people who quoted things that I've said, and I've usually stolen them from other people. And that particular one, I believe I stole from a guy by the name of Ron Ryan, who is a bond consultant. And what you mean by that is that once you have acquired enough money to retire on, why would you ever put any of that at real risk? Okay, now it doesn't mean sell all your stocks, but it does mean cut your risk level down a great deal. I define what's known in finance as a liability matching portfolio, which I think is about 25 years of living expenses, okay? Mm-hmm. Once you've gotten to that point, you should and especially if you're approaching retirement, if you're 60 or 65 years old, you should probably dramatically cut down your stock exposure. Now, that doesn't mean that if you have money in excess of that, you can't put it at risk. But understand that as you get older, if you're very lucky, you really have two pools of money, okay? One is the amount of money that you absolutely need to live. So let's say, for the sake of argument, that you need $70,000 a year to pay your basic living expenses and have a decent standard of living, okay, mm-hmm. in retirement. Let's say you're getting 30 of that from Social Security, which means you need 40. Okay, from somewhere else. Well, that means you need to save $1 million. All right, 40 times 25 is $1 million. Now, if you're lucky, all right, then you've got $2 or $3 or $4 billion. So the extra money you have on top of that first million is money that really isn't yours. You're not probably going to spend it, okay? It's going to go to your kids. It's going to go to your charities. It's going to go to Uncle Sam. It's going to go to somebody else. And, maybe you can tap it to finally buy the Beamer or fly first class. But, once you reach a certain age, say above the age of 55 or so, or 60, you really shouldn't be putting all of your retirement money at risk, because if you've won the game but you keep playing, you could lose it. And that gets to another thing, which I am fond of saying, which I think I invented, which is the job of investing, or the purpose of investing, is not to make you rich, okay? It's to make sure you don't get poor. And the problem is that a lot of the things that offer a chance of making you really rich are also the very same things that are most likely to make you poor, okay? Trying to pick 5 or 6 stocks and restrict your holdings to that, yeah, there's a chance you really could hit the jackpot with one of those stocks, okay? But there's an even better chance that all 6 of those stocks are going to do not well, all right? And so you've just given yourself an Alpo diet when you're retired.
Right. So let me ask you this: there's a pretty significant surge now in all these blogs and people talking about retiring early. So traditionally, retirement age is 60s, 65, and as we're living longer, some people have advocated even going beyond that. What are your thoughts about, I don't know if you met Physician on Fire at the White Coat Investor Conference, but, just people retiring early, and how does that change the equation for, investing or asset allocation?
Well, the younger you want to retire, the more money you're going to need. All right. I mean, retiring, what we like to tell people is that at a 2% burn rate, you're bulletproof. At a 3% rate, you're probably safe. At a 4% burn rate, you're taking real chances, although you'll still probably do okay. And at a 5% rate, you're probably in danger. Your retirement is probably in danger in your later years. And that's if you retire at 60 or 65. All right. If you're one of these people who wants to retire at 40, you'd better have 50 years of living expenses saved up. So that's the first thing. And you also better have something that you really want to do with the rest of your life, and it better not be golf.
Right. Yeah, it's true. And you obviously you have a much shorter time span into accumulate those assets. So it's interesting. And we're in that moment right now where a lot of people are doing. Obviously, it's not a huge percentage, but it is a number of people that you're seeing. So it's interesting to see how that will turn out, especially as lifespans, increase with advances in medicine and healthcare. So
it's funny. Seems that every year I go to the Bogleheads Conference, which is the Vanguard enthusiast conference in Pennsylvania every September or October. Somebody I know comes up to me and says, "Oh, there's a couple that just is dying to meet you," and invariably one of the couple is a neurologist. That's the low earning part of the couple, and the other one, is an ophthalmologist or a plastic surgeon or a gastroenterologist, and they say, "Gosh, I've read your stuff, and I think I can retire when I'm 39." And I look at them and I say, just God bless. I wonder what happens to those couples.
Right. Yeah, I know. Well, a lot of them are blogging now, so we'll see how that pans out. I think it's interesting. I completely agree that even if you have the assets, you better have something more meaningful to do than golf. I mean, don't get me wrong. If you enjoy golf, but that cannot be the only thing that you do. So, kind of finish up here, but one of the debates that seems to be an eternal question in the financial bloggers and social media world is, do you think most physicians should have a financial advisor?
Yes, I think they do. And because I think that most physicians don't have the time or the discipline to do it for themselves. I think it's a more general thing. I think with our current system, it's probably necessary for most people. I think very few people actually have the equipment or the interest to do this properly. And I'm not, obviously I'm self-interested in this. I am an advisor, but I think that the whole system stinks. I think what we need, quite frankly, I wish that we didn't need financial advisors. I wish that we had a decent national pension system, the way the Dutch and a bunch of other northern European countries basically have. I mean, expecting the average person to save and invest on their own is kind of like expecting people to fly their own airliner or take their own kid's appendix out.
Right.
I think it's and in fact, I mean, how hard is taking out an appendix? Investing is much harder.
Right. So I want to thank you, Dr. Bernstein, for participating in this podcast. Great advice. And I encourage the listeners to visit Dr. Bernstein's website at efficientfrontier.com. He's got a tremendous list of books, many of which are not even the ones that he's written, but good financial books. And I think you have an outline, like a study guide, like you're describing.
I have two things. I have a reading list, but even better than the reading list is just the free download I have, which is the little booklet, If You Can. Right. And just put the, if you can, and my name into any search engine, it'll pop right up. And that's the study course. That's the roadmap to Jerusalem. It won't take you there, but it'll give you the map to get there. Great.
Well, Dr. Bernstein, thank you for coming on the show. I appreciate you taking your time for our listeners, and I encourage all our listeners to visit the website and read some of his Dr. Bernstein's books. They're tremendously educational and good reads. So thank you, Dr. Bernstein.
Pleasure was all mine.
Okay, thanks for listening to another episode of the Dr. Money Matters podcast. I want to thank Dr. William Bernstein for being my guest today. I hope you found him as entertaining and as educational about the basics of investment as I have, and I encourage you to read some of his books as they range from the relatively straightforward beginner's guide to more complex and esoteric topics, and I guarantee you'll learn a lot of valuable information. If you'd like, please join our email list, and I'll tell you how to get a copy of his beginner's book, If You Can, free for Kindle. And please consider joining our Facebook group, Dr. Money Matters, where we discuss a lot of the same topics that we talked about on the show. And as always, please leave positive reviews on Apple Podcast or wherever you listen to your podcast. That continues to help us move up the rankings and lets this show grow. Once again, you can follow me on Twitter at Dr. Money Matters and on Facebook or Instagram at Dr. Money Matters, all spelled out. And thanks for listening. Another show will be coming soon. And I forgot to say this, but Dr. Bernstein's website is efficientfrontier.com, and I'll link to it on our show notes to the page where he has a really good reading list for anyone interested in financial literature. It covers a variety of topics, including his books and his recommended books by other authors that you should really read before you develop your own investment philosophy.